Welcome to Inside Abode, ladies and gentlemen. How are y'all doing? This is the second live we've ever done. So I'm, excited about this live. I'm really excited about this one because we have a special guest today. We have a really special guest today. I'm going to get into that in just a minute, though. And you already know because you probably saw the title if you're listening to this after the fact. But we are in our second live, and I'm doing this to change up the format because, one, I like it, and two, I'd like to do this more often, potentially. And, like we always know, we try to drop some gems and try to have some timely content for you. Obviously, this is a big week. I'll probably talk about the election on another, podcast and get some people in here to talk about that. We can chew on it a little bit. But the show must go on, right? And, it's a hard week. I ain't gonna front. Like, it's hard for me. So just from a social standpoint, there are some economic benefits, I guess, if you will, short term, to this presidency taking the office. So with that, we're going to have a chance to unpack all of that, though. So let's get to it. Before I get to my guest, I want to ask you to subscribe. I want to let you hit that little button because it costs you nothing to be up on the podcast. And we got some things cooking for you. So really excited. What's going on around Abode? Abode right now, you might hear some construction in the background. We're working on expanding our space here in Old Town, and so we're really excited about that. We're looking forward to 2025 and just trying to, end the year strong and make sure that we, are in position to make sure that we serve our folks to the best of our ability and the community. So we got that going on. You'll probably see some more stuff and changes and things of that nature coming on different, pieces of content that we throw out there. So just stay with us, man, and watch us grow. We finna grow into the next one. We're doing 360 videos. We got some stuff cooking. So anyway, I want to get to my guest. So my guest is waiting. My guest that I have on today, he graduated from UW Washington. If you're a dog, go Dogs. He moved from the East Coast, Virginia to be exact. He's a Virginia boy. Ryan would like that. I already said he's UW grad. After he graduated from UW with a master's in economics, he then went to Zillow and spent 5.5 years at Zillow. And now recently he was just named principal economist of Windermere Real Estate. So bringing on today, I have Jeff Tucker. Jeff, how you doing, man?
Hey, I'm doing great. Thanks. It's great to be here. Thanks for having me on.
Yeah, man, I'm really excited because you just recently started with Windermere and just started putting out content and stuff like that. And we were talking before we went live and just talking about the process of creating content, and it's great to just start. And I'm watching you do that in real time, and it's really cool to watch you just grow on a content front.
Thanks, man. Yeah, I'm trying to learn from pros like yourself how to meet people where they are, how to put out content where agents, brokers, everyday people, mortgage loan officers, anyone who's trying to get a better feel for the housing market, where they go to get information and to stay up to date on things. So yeah, that's YouTube videos. It's putting things out on Facebook and Instagram, on Twitter or X, LinkedIn. So trying to meet people where they are. And there's so much news happening. I mean, all the time, but the housing market has been on such a roller coaster the last few years. I feel like it's, for folks trying to transact in it, it's a lot to keep up with. It's even for folks who are not transacting, it's like one of the top topics at the playground during our kids' soccer games and things like that. Seems like everyone's talking about it.
Yeah, and rightfully so. There's, I think it feels like, well, we'll get into the numbers in just a minute, but I know that for our agents, it's been like really sticky. The transactions have been really sticky, because people have to really pay attention to what they're doing, because of the rates being so high. It's a bigger decision, I guess, if you will, right now financially for a lot of folks. Whereas before, when the rates were really low, you kind of could just finagle in and out of stuff, and where that's not the case, or at least from what I said. And it's always going to be sticky too. Like transactions are always complicated and nuanced. Just
Yeah, for most folks, this is the biggest transaction they've
yeah,
ever made. When they go buy that first house, and in a region like the Northwest, and frankly, all around the country nowadays, affordability is stretched so far that, yeah, as you said, the stakes are really high. This is a really important decision. That's both the most expensive kind of decision you're making, one of the biggest pieces, probably the single biggest piece of your monthly budget,
right.
and the biggest determinant of how you live your everyday life, who your neighbors are, what your street is like, where your kids go to school if you got kids, what your commute's like, that kind of thing. So
Right.
it's high stakes. So you want to get it right.
Mm-hmm. Yeah. And so let's go back to like I gave the intro. You're from Virginia. Like what do you remember most about Virginia that you liked the most about Virginia? Because I know because Ryan Nicey is an agent in our office. He's from Virginia. He loves him some Virginia. So what do you remember? What's one of your fondest memories of Virginia?
So a couple things I do love. I love history, and so I mean, there's a lot of there's Jamestown Fort and
Mhm.
Island and the archaeological dig there. My grandparents actually volunteered with some of the dig and finding artifacts, and
Oh, wow.
they kind of they rediscovered in our lifetimes. They rediscovered the actual location of the original fort at Jamestown Island and
Damn.
excavated it. Got all these artifacts out. So it was cool. So I grew up in Williamsburg. My family would like go on bike rides down to Jamestown Island. It's like 5 minutes
Wow,
away.
that's crazy.
So like just being right there and learning about history, I think was really fascinating. The other
Hmm.
thing there is Busch Gardens, Williamsburg, the best roller coasters, the best,
Oh,
yeah, the best like theme park. It's like old Europe themed, and there's
okay.
like little old England, old Ireland. There's Oktoberfest. We used to get season passes. That was a blast. So I have a soft spot in my heart. And honestly, the one thing that I really feel like the Northwest is missing are some
Uh,
good roller coasters, some good theme
you're
parks with
you
some
are
really
right
big
about
roller coasters.
you are right about that. You're definitely right. Yeah, if I had to think about it, like where do I go to go get on a roller coaster? It's the Puyallup, or it's not the Puyallup Fair anymore. It's the Washington State Fair. But like, yeah, it'd have to be the Washington State Fair. So that's the only roller coaster we have, and that's when you go to like a theme park, it's just not it. But yeah, that's interesting. What do you like most about being on the West Coast now? You came over, you said your wife is from Alaska, and now you're on the West Coast. You're in Washington. What do you like best about being over here in Washington?
Yeah, that's right. My wife is from Kenai, Alaska, on the peninsula south of Anchorage, and yeah, she always told me you got to try my side of the country. You got to see the mountains and the ocean out west, and that's what sold me on it. The mountains and the ocean. If you're watching the video, you can see Mount St. Helens here. My wife painted that picture behind me. We love hiking Mount Baker, anywhere in the Cascades, the Olympics. It's just the best. And when the mountain is out, there's nothing better. So
Yeah.
love the mountains. I like the climate. I like kind of a mild climate. Doesn't get too hot in the summers,
Hmm.
and I love the neighborhoods and the cities of the Northwest. I love Seattle. I live in West Seattle myself, but
Okay.
we've also got family in Tacoma, so we go down there pretty often.
Oh, okay. I didn't know
Yeah,
that.
yeah. My wife's cousin lives there with their family. They
Oh, wait, you
they
did
bought
say that.
yeah
You
they
did
bought
say
this
that. Yeah.
awesome craftsman in sort of in the Proctor neighborhood
Right.
a few
Yeah.
years back, and so it's seeing Point Ruston. Yeah, just exploring the neighborhoods around here. I think they're so beautiful. The variety of architectural styles, the variety of gardens, and I love all the hills. Walking around neighborhoods, you come around a corner, you go over a hill, and you just get these views every which way.
Yeah.
So that kind of topographical relief, you see the water. I just love it every day going on walks around my neighborhood.
Yeah, we really I think for natives here we take the mountain for granted, I think. I think that we really do. But all right, well, I know people came here to talk numbers. They want to know about this market. So let's talk about the market. Let's get into that real quick. So the first question I have for you, and this is a big week, and a lot of data just came out, so it's really nice. So for those of you watching, he's going to have some charts. Just going to have some charts and show us some charts. But the Fed just lowered the Fed rate a quarter point. So, like, what were some of the factors that that influenced that move, that decision to lower the rates, or what might be some factors in the future that, where are they at in terms of the rates? Are we going to see lower rates moving forward or whatever? Let us know. Give us the skinny on the rates, man.
Yeah, that's right. So this was a widely expected move by the Fed. And let me grab some charts to kind of put in perspective a bit.
Yeah.
Make sure I can do this. Here we go. Let me get the right chart queued up.
Yeah, all good.
So it was expected that they'd kind of signaled this basically ahead of time that they were planning to make this cut.
Okay.
And so to kind of put it in perspective, we've taken a couple steps down. The Fed made their first cut, a big one, a 0.5 point cut back at their September meeting.
Right.
And that finally brought us down from this level up around 5.25%, where we'd been sitting ever since late 2023. Because, and so to sort of think about why the Fed's cutting now, it helps to wind the clock back and ask, well, why did they jack rates up so much? Really to the highest level in a generation starting in 2022. Well, the answer is they were trying to get a lid on inflation, really.
Okay.
Inflation was hotter than it had been in a generation. This is, and obviously that's a hot topic. This had major ramifications, I think. I think it had ramifications in the election. This was something that people did not like. People do not like inflation. And the Fed has a dual mandate, which is to keep inflation low and steady. They aim for 2%, got way the heck above that, up to 9% at one point. And they want to support the job market, support the economy, and they also don't want a bunch of unemployment. So that, when inflation got really high, they said, we got to fight this. And the way that the Fed fights inflation is by jacking up interest rates. So that's what they did. We did see inflation come back down. It's decelerated. Mm-hmm. So where we are today is they've seen inflation move back close to that goal of 2%, especially if you look at the personal consumption expenditure price index, which is their preferred measure. It's getting close to 2%, still a little bit faster than that. Okay. And, again, speaking of how pissed off everyone is about prices, I know it's a very valid point people will make, which is that a slower pace of inflation doesn't mean prices actually coming back down. So the price level still feels high to a lot of people, but the Fed is focused on that pace of change, and it's come back down. And then the other side of that dual mandate is they're worried about unemployment. They don't want to see unemployment keep rising. And we did see unemployment come up from about 3.6% to as high as 4.3% over the course of this year, basically over the course of 2024. Mm-hmm. And that's worrying. They don't want to see more people lose their jobs. And historically speaking, when unemployment has kind of bottomed and it begins to rise, it goes up by 0.5 point like that. Mm-hmm. It usually keeps going up. So they're worried about that. Yeah. And they don't, they don't want that runaway growth in unemployment. So they've hit a point where they're trying to balance these competing objectives of get that inflation back under control, but also don't kill the labor market at the same time by trying to fight it.
Right. Is that employment rate? So you mentioned that it typically will continue. Is that because it's like a lagging indicator, or is that just because it's just a kind of a compound effect?
It is a bit of a lagging indicator. And I think the other way you put that, compounding effect, is that there are these kind of virtuous and vicious cycles that can get underway in the economy, where as people lose their jobs and cut back on spending, or they lose confidence in the economy and their finances, they stop spending, and one person's spending is another person's income. Right. So as that money stops circulating as much, more people lose their jobs, and you can get that vicious cycle. So if the Fed can kind of nip it in the bud before we get on a runaway growth of unemployment, that's kind of what people mean by achieving a soft landing. That's been kind of their goal, is get that inflation back down, but without crashing the plane, essentially, sending us into a recession. Yeah. It kind of looks like they're pulling that off. It's probably still a little too soon to tell, but so far, the unemployment rate actually ticked back down a bit the last couple months. Okay. And it's mixed. We're getting a lot of mixed signals. So I think the jury's still out on whether unemployment will get worse. But at the moment, it's historically speaking, we're still at a pretty good level.
Yeah, the part about the unemployment, what I find is fascinating was, like in 2023, for example, I'd be talking with other, lenders and people that on the economy, and it's like we wanted the unemployment rate to go up, which is kind of a weird thing to say, like, and it's speaking from a place of privilege in some ways as well, like because we're like, hey, yeah, we want the employment rate to go up. So it's just like, man, that kind of sucks. Like we're basically saying we want people to lose jobs, but like at the time we just needed the rate. Like, I mean, looking at the charts, it's like, yeah, like we don't want the rates to keep. They had to keep doing that because we just kept spending. Um, and I just found that interesting. The other thing is, in terms of like, do you feel like the Q4 holiday season will have an impact on the unemployment rate as well because like of seasonal employment?
Yeah, so that unemployment rate, that headline number is seasonally adjusted, but
Okay.
making those seasonal adjustments is hard. And it's been one of the challenges in the pandemic is that a lot of kind of seasonally adjusted numbers have been confusing. And you're
Okay.
absolutely right. There's this surge of employment and job activity in the retail sector in
Mhm.
Q4 every year. And
Right.
so we're trying to adjust for that, but there's a mix of sort of traditional kind of seasonal Q4 winter activity, but also the way our economy is changing and more of that activity, going online, shopping on Amazon, kind of delivery and warehouse workers to make those retail sales.
Okay.
That's changing the kind of the shape of it for sure.
Yeah. No, that's interesting. Thanks for sharing that. That graph is huge. So as we're looking forward to 2025, what are some of the like key indicators or trends that you see that will potentially that you believe will maybe shape the housing market? And let's just start nationally. You can speak from a macro standpoint, or if you want to speak from a regional standpoint, it doesn't matter to me. But what trends do you see coming up that potentially could shape the housing market in 2025?
Yeah, so I think that the elephant in the room is mortgage rates. So I'll start there. And that's actually the factor I'd say is most unpredictable. It's the hardest one to predict right now.
Mhm.
So I'll just share one snapshot from a website I like called Mortgage News Daily. It's one of the few places that
Okay.
publishes a daily index of mortgage rates. So this is the 30-year fixed,
Okay.
and it's been kind of all over the board. I titled this Higher and Choppier. So right at
Right.
the moment, as we're talking on Friday, November 8th, rates stepped down to 6.92%, but that's way up from where they were in September.
Mhm.
So that movement, the last couple months, has kind of blown up this previously sort of steady, predictable narrative that we'd been having for
Mhm.
most of the year, which was rates working their way down ever since May. They got as
Mhm.
low as like 6.1%. And we really saw home shoppers respond to that. We saw
Okay.
more housing market activity, especially in October, oddly enough. So a bunch of closed sales. So I think people who, closed on that loan, closed on that home, who made that offer, got it accepted in September. Then they
Mhm.
closed on their purchase in October. So we got some, especially in the Northwest, actually some pretty strong sales numbers in October. So I do think those lower mortgage rates were helping buyers get back in the game, helping
Mhm.
kind of unfreeze this market a bit.
Yeah.
And now they've jumped back up, and so now it's like, well, where are they going to go? And everyone's trying to kind of piece that, untangle that. Like, what's the deal? Why did this happen?
Right.
Um, and I think it's especially confusing for a lot of folks because wait, didn't we just say the Fed cut interest rates?
Yeah. Yeah.
So, I've got this one chart so this is the yield curve, and it's a
Mhm.
very wonky kind of subject, but it's what it helps kind of capture and is really over on the left is kind of short-term interest rates. And I think that's just the biggest distinction to keep in mind is the Fed, when the Fed cut rates a quarter point yesterday, that's the overnight rate. So if you think of how long a loan can be,
Mhm.
overnight is about as short as you can go.
Right.
30 years, like a mortgage or 10-year treasury yield, those are like the long end of
Yeah.
how long debt can go. And so the Fed is controlling that really near term
Yeah.
interest rate. It can have counterintuitive effects on the long end.
Got
And I think what has kind of happened here is that risk of a recession has faded, basically. And so
mm,
when investors, the number one thing that can really cause interest rates, including 10-year treasury yields, including mortgage rates, to plummet and end up in the basement for years on end is a
mm,
recession.
okay.
So if folks were thinking a couple months ago, we might be sliding into a recession, that was
Mm-hmm.
getting priced into the yields, into the
Got it.
bonds.
Got it. Okay.
And now we've gotten some good news in the last couple months, some good economic news as well. And even part of that picture, this is the most paradoxical part of that picture was the Fed jumping in with a big half point cut to start the rate cutting cycle. That signaled Jerome Powell came out and said, we'll do what it takes to stop a
Right.
recession. Even
Right.
if one's starting to brew, we're going to nip it in the bud. We're willing to do big cuts. We're not afraid of that. Um, and so as that as that kind of reassured investors, okay, we're
Mhm.
probably not going into a recession now. That started to cut off some of that sort of hypothetical future of rates in the basement for years.
Yeah.
So as that possibility goes away, then rates get a bit higher. So yeah, where we are now, rates are kind of high again, unfortunately.
Yeah.
Back up close to 7%, kind of the upper sixes. So that's one thing to watch. The other thing is now, just in the last week or two, the markets are really trying to digest the news of the election. What is that?
Right.
What is that going to
Right.
mean? That's for one thing. There's a bit of uncertainty. I think
Mhm.
if it had gone the other way, then it would have been a bit easier to say, okay, we'll see a continuation, sort of continuity of the Biden administration's economic
Yeah,
policy.
because they have a 4 year window to look at and say, okay, I know I kind
Yeah,
of do this.
but now I think there's a lot of questions. I think the two big economic policies probably are going to involve tax cuts, sort of because
Right.
we had the expiration of the 2017 Tax Cuts and Jobs Act tax cuts. Now the Congress is probably going to be in a position to extend some of those.
Right. Right.
And the other big priority is tariffs. And
Hmm.
I think on both of those, so we know sort of the direction that maybe policy will go. We're not so clear on the magnitude. How
Right.
big will those
Right.
tax cuts be? How big and broad will the tariffs be? Everyone's trying to figure that out. Broadly, though, both of those policies would probably tend to push inflation up a bit. Tax cuts, that's fiscal stimulus. That generally tends to push up inflation, all else equal. And
Right.
tariffs tend to raise the consumer prices that we pay because so many of our goods are imported. Uh, so if those are both kind of inflationary, then that'd be one reason maybe to that higher inflation tends to push up, mortgage rates like we're looking at here. So
Yeah.
that that could be playing into things as the market priced in both the rising likelihood and then now the certainty of this election outcome we got.
Interesting. Yeah, thank you for sharing that. That's really good info. I the tariffs part is fascinating. I know it doesn't have anything to do with, well, I mean, it does have something to do. There's impacts, but you said a tax cut and tariffs being the two policies, monetary policies that are potentially, on the table. And so here's one thing that I look at. I look at the M2 global money supply as well, just to
Mm-hmm.
kind of, get a grip on like where the money's kind of shifting. And right now, or at least people I'm talking to, and or at least people I listen to, it's starting to tick back up, in terms of just the global liquidity. And so is that I want, and I'm wondering if that's going to have an impact on all of this, and whether that liquidity will cycle through to consumers or businesses, or where it's going. I don't know. I just don't know. But do you have any? Is that going to have any impact as well with the tariffs and tax cuts as well?
Yeah. So, you know, higher money supply and kind of looser monetary I see that kind of going hand in hand with looser monetary
Yeah.
policy, which
Yeah.
is part and parcel with those short-term interest rate cuts. That would be maybe another piece of a puzzle that adds up to a bit more of an inflationary environment. And higher inflation means higher rates,
Yeah.
including higher mortgage rates. So that is probably a piece of the puzzle. Um, I guess the one other thing I'd sort of say about the money supply and monetary policy is that the one other thing going on in the background is that the Fed has this huge balance sheet where they went out, they bought a ton of treasuries and mortgage-backed securities early in the pandemic.
Yeah.
That was that's their way of kind of pumping money out into the money supply.
Okay.
And that balance sheet, though, they've been letting that shrink in large part through running off the principal on those mortgage-backed securities, which just means, every month I've got a mortgage. Every month I, send some fraction of my mortgage is paying off the principal on
Right.
that note. And so it just keeps shrinking. And so as everybody's, just gradually kind of paying off their mortgages, the Fed's balance sheet is shrinking.
Yeah.
So that's the one piece of this puzzle that's rowing in the other direction a bit. They're no longer going out there buying mortgages, trying to kind of directly impact that. And by letting it kind of shrink, letting that balance sheet shrink, that should be a bit contractionary. So one piece, one bit of wind in the other direction against an inflationary environment.
Okay. And you kind of alluded to this already, but how will any of those trends or factors impact like housing affordability and buyer demand, like in the country?
Well, no, we should definitely jump over it, like think about the housing market more specifically here. So let me
Sorry,
grab
I
some
got
of
you in
those.
the weeds a little bit. I like talking about that kind of stuff. I know the listeners want to hear about the housing market. But it all impacts it though. It all
totally, yeah. I mean, how mortgage affordability, both when it got really good, frankly, in 2020, and then the worst ever, essentially, by 2023. That has been the elephant in the room. So that's why we focus so much on it. And a lot of the impact of that shows up in inventory. So this is I think of inventory as kind of like the barometer for the housing market.
Okay.
And what I mean by inventory is usually I say active listings. And so I'm borrowing a chart here from Realtor.com that's published, created by National Association of Realtors, I think, in the background there. But this is one of several public sources. Any listener can go find it, download the data yourself. So I always love that when there's public sources for data.
Yeah, same.
And so when I say the barometer for housing, inventory kind of, it's both kind of the consequence of that balance of supply and demand, and starts to have an impact on activity going forward. So it's both kind of cause and effect. And what I mean by that is when demand is really outstripping supply, it pushes inventory down. It's, it's like the shelves are bare at Costco in March 2020 because everyone's buying toilet paper. That's when demand really outstrips supply. Well, our housing market shelves also got pretty bare by especially 2021. That's kind of the green line on this chart, if you can see it. We had the lowest inventory ever on record in many months of the year because demand was outstripping supply. And that when inventory is super low, that also creates price appreciation pressure because, several people really want to buy a house this weekend. There's only 2 or 3 houses on the market to choose from in the neighborhood. They're all going to be in the same open house, bumping shoulders and getting in a multiple offer bidding war against each other. Flip that all around, lots of options out there, maybe some of them sitting for several weeks.
Right.
Then buyers don't feel so frantic. They don't feel like they need to waive every contingency, offer way above list, put escalation clauses. I'm sure you've seen all of these kinds of sometimes almost manic moves that people needed to make to win an offer back in 2021. Those have largely gone away for many folks. When inventory gets higher, then the market's not so manic. It's not so crazy like that. And I do think it's just a healthier market too, where people don't feel that they need to rush into something and waive their contingencies, and where they feel when they can look at a bunch of options and that helps them find the right fit for their family. So
I'm glad you mentioned that. I'm glad you mentioned that because I agree that it's just health. It seems like a healthier market, even though we're hurting. Like there's other industries that are hurting and people are hurting, but I feel like just the pace is definitely more sustainable.
Yeah.
on all fronts.
Yeah. So as you said, though, that the sales volume is still really low. Let's see, I
Yeah.
had one other version of this. The one thing people do worry about, I hear this a lot, I've heard it for a few years, that if inventory rises, they kind of worry, okay, are we headed for a glut? Will that cause a
Yeah.
market crash
Yeah.
and so on? I don't think we're really at risk of that. This is that same data actually, but it's weekly data and it's showing the year over year change.
Interesting.
And my main takeaway here is just it kind of curves over at the end. That inventory is up year over year, but not at an accelerating pace. It's not taken
Yeah.
off for the moon.
Okay.
It's so I think we're kind of easing back toward a more normal level of inventory. You
Yeah.
did mention sales, so then I'll turn to that real quick because sales activity is still really low.
Hmm.
Existing home sales is this year, the last 12 months, according to data from the National Association of Realtors, that was the fewest existing home sales closed almost on record.
Oh, really?
It was less. The last couple of years have all been kind of competing for that title, but like the last 12 months was even lower than like 2009 or 2010
Oh, wow.
for existing home sales volume. So that's why sometimes I've been referring to this market as kind of frozen. Was
Yeah.
just not a lot of people transacting and moving. So
Realtors,
what
did
we've
you
been
hear that?
watching for is kind of like that turning point. We're looking for kind of signs of life,
Yeah.
and we did see some signs of life in October, especially in pending sales.
Oh, yeah, we saw it.
Um, did you feel it in your
Oh,
market?
yeah, I mean, yeah, we saw it. We felt it, or at least just in this office for sure. Our folks are definitely getting stuff under contract and really helping their clients, get into homes. And we just saw an uptick in activity and in the month of October for sure. And it was like very noticeable.
That's good to hear, and it's always good to hear that some statistic I'm seeing on a website is matched by activity from
Mhm.
the real
Yeah,
world on the ground experience
yeah,
in an office. Um, so what I took from that was that condition, the kind of the pendulum had swung in buyers' favor. There was more inventory to choose from, like I was showing a second ago, and those mortgage rates came down. And even though the Fed cutting that short term rate in September, um, even though that didn't cause these lower mortgage rates, um, I think it I think it broke through the news cycle. I think a lot of people, if you
yeah.
look at like Google Trends for like searching for the word mortgage, it
Mhm.
spiked as soon as Jerome Powell cut that benchmark rate. Because
Yeah,
I think that's when people heard, oh, okay, now we're in a world where interest rates are coming down,
right.
and they went and found out, yeah, interest rates came down almost a point or more from May to September this year. Then they got out there and said, all right, let's make a move.
Yeah,
That kind of, it was like a perfect storm of good conditions for buyers, more inventory, lower interest rates. And so for me, this is kind of my key proof of concept to thinking ahead, is that for the housing market next year, is that if mortgage rates can come back down, buyers are ready to jump off the sidelines. Buyers are ready
right.
to jump back in.
Yeah. No, I agree. I feel like it seems like it's a ball, just a ball being held underwater, to me, in terms of the money that's sitting on the sidelines, just waiting for the rates to come down to where it's manageable. Um, because to me, I look at it like even just from a social standpoint, you have this time frame where people don't make a move, and just in general, and people get antsy, things happen in life or whatever, and you might stay in a situation because it's just not affordable to do anything. But the minute it does, like, and then you have investors who are sitting there like, yeah, I'm not going to invest at that rate. But when it does, and so now you're going to have this like clash of like life stuff happening over 2 years, and you just can't make a move, and then you're like, I got to get out of here, or I got to whatever, like, I don't know. I just feel like there's this pent up demand that's like getting ready to just want to scream.
Yeah, I think that's right. That you can't put life off forever.
Right.
These life events are piling up out there.
Yeah.
People's kids are they're getting bigger every year. They're another year older every
Right.
year. People have more kids. People get married or divorced.
Yeah.
They get a new job. They need to relocate. They retire. Like there are all these life events that keep happening, and often they trigger the need to move, the need
Yeah.
to buy or sell a house. And so I do think a lot of people were pushing that off, putting that off as long as they could. But the longer they wait, the more kind of urgent that becomes to actually make that move.
Right. Um, so what are your thoughts on any, like, is there any regional disparities you see in the housing market? Does that, so like all the things that we're talking about here on the national scale, does that apply regionally?
Yeah. So actually, if anything, that sales activity in October picked up even more. Let me jump back ahead here to some data from the Northwest MLS, which covers most of Washington, but especially Western Washington.
Mm.
And that boost in activity. So we nationwide, there was an extra 10% pending sales growth year over year in October.
Mhm.
In the Northwest MLS area, it was 27% more.
Oh, wow.
Like that's a huge gain.
Wow.
That's
Yeah.
that's really extraordinary, actually. And if we dig into uh, King, Pierce, and Snohomish counties, so those are the three counties that technically make up the Seattle metropolitan area. They
Mhm.
they had really big jumps. So yeah, King was up 33%, Pierce up 26%, Snohomish up 20% year over year. Sorry, that was actually that's closed sales in October, year over
Yeah.
year gains. Um, Pending sales were up even more in October than that, especially in Pierce. So Pierce, we saw 38% more
Wow. Yeah.
pending sales year over year in October. That's nuts. You
That's
don't expect to see a year over year change like that because
right.
housing's so seasonal. This is why we like to look at the year over year numbers. October, your best comparison to October is another October, because it's a different time of year than like April
Right.
or May. So seeing this year over year growth, that looked to me like, to whatever extent national um, uh, home buyers were sensitive to interest rates, they're even more sensitive around here, around the Seattle region,
Mhm.
um, and so when those rates came down and the news got out about rate cuts and so on, people jumped off the sidelines. They were ready. They were ready to move.
Yeah, that's interesting to look at. Yeah, thanks for sharing that. It's well, based on what you've been talking about. So it's kind of like it feels like, so with the rates that we're talking about, we kind of don't know. We have a new you know, administration coming in. We don't know at which rate that they're at, the magnitude of which they're going to do things. And then, but this is positive to look at. I think that I I do believe, like, do you feel like there's a regional advantage, I guess, if you will, that we have to being around the sound, being in what I like to call Silicon Valley 2.0? Is there any advantages to being in our region, specifically in Washington?
Well, yeah, I mean, I think it's the greatest region in the country, but in terms of the housing market, there's no question that, as you put it, being Silicon Valley 2.0 plays a big role. That has helped drive a lot of the demand to live here, as well as the purchasing power necessary to afford where prices have gotten.
Yeah,
Frankly, I think a lot of those kind of a lot of the people are able to move in and buy houses at these prices, even as interest rates have stayed high. In many
yeah,
cases, it kind of requires almost that tech salary,
right.
or requires a lot of help with the down payment. Maybe you bought a house 10 years ago and it appreciated so much that home equity became your next down payment, or maybe you got help from your parents.
Yeah,
So I do think that actually that kind of thing of getting help on the down payment is going to keep looming larger in the housing market here.
yeah,
Um, and that's unfortunate. I'd say that's unfortunate from an equity standpoint, and it's really kind of reflecting generational entrenched inequity.
yeah,
But I think that has become a fact of life for many folks, that the down payment is too daunting, or that monthly
right.
payment, without something to kind of push down that principal, is out of reach for a lot of people. So, I mean, I do think that affordability in this region is at crisis levels. It is,
Hmm.
so I should say unaffordability is at crisis levels. Um, so that continues to be a major challenge here. But yeah, I mean, when you see these sales, there's certainly a segment of folks who are finding a way to make that work, who are buying and transacting in this market.
Mm-hmm.
And they're,
They finding
they're
a way.
forging ahead.
I seen them. They finding a way. There's people finding a way. I've seen it. I'm watching it. I'm like, okay, like people are figuring this out. And that can look a bunch of different ways. That can look in, multi-generational. It could look house hacking. It could be people, like people combining to form an LLC and buying, I don't know. I've just seen all kinds of different stuff out here. And I think that's one of the benefits of a tough market like this is people get creative, and figure out how they're going to provide housing for themselves. So for a parting message for people, or did you have anything else to say on the regional side of things?
No, I think just to sum it up, I'd say that, yeah, we saw some real signs of life of renewed activity when interest rates came back down. So my takeaway is still this region is even more sensitive to interest rates than the country at large. So if rates do kind of resume that downward trend next year, I would really expect, and as you put it, sort of holding a volleyball underwater or whatever, a beach ball underwater.
Yeah.
I am expecting a busy spring buying season for this region in particular. Yeah.
Yeah, I agree. Based on what I just saw last spring, I just feel like with potentially, who knows, but with potentially more rate cuts, I know it might not be the mortgage rates that come down, but it's still, I just feel like there's enough people who've lived life, who've seen this and are kind of getting used to this territory, I guess, if you will. We have one more year of experience in this rate range, and so it feels like people adjust accordingly to whatever housing market they're in, and then have a need that they have to just do whatever they got to do. And looking at the data, I mean, that's positive that we're up year over year in these counties. So, thank you for sharing that. That's good. So, what parting message do you have for buyers or sellers right now?
Yeah, so I'll stop sharing there, but I think my message to folks out in the housing market is all right. So for buyers, what I would say is that decision of buying a home, it's really got to be about the home and your needs. It's so all this data is useful, but no one can predict the future. We just saw that with interest rates. They came all that way down until September and then jumped back up. So don't just sit there on the sideline waiting for interest rates to get where you want them to go. What you need to ask yourself is, so you find a house and you ask yourself, is this a house where I'd be happy living, where it meets me, it meets my needs, meets my family's needs for at least the next few years that I can predict? Would I be really happy there? And can I afford it at the mortgage rate I'm getting today?
Right.
That's what you need to ask yourself. And trying to make predictions about all these other trends and stuff, that's not where your head should be at. Your head should be at, is this, will I be really happy in this house and can I afford it? Basically, that's what you need to ask yourself. And at the moment, I would also say this is a quieter time of year than the spring. There will be, kind of more new listings hitting the market every week in the spring. That'll be fun to look forward to, but there'll be a lot more other buyers out there bumping elbows with you at the open houses. So if you want to buy a home without getting in a bidding war, your best chance is Q4. We're in it. The winter, the holiday season is a great time to do that. I'm sure you can back that up, Dave.
Oh, 100%. I have someone who just moved from DC over here, and they started in like September or whatever, and house came up, and it was just like, hey, we like this one. It was like literally 40 minutes after it went live. And I looked at it and I was just like, oh yeah, there's a bunch of people that like that. And of course there was already an offer on that night. You know what I mean? And so I think the houses that are the ones that people want. If you sit there and you say, wow, I really like that. If I'm talking to buyers now, if you really like that house, like chances are there's someone else that likes it too. Like I think that, but I like your message of, don't try to time the market, like that's how I always say it. It's like, don't try to time the market, but it is helpful to know what market you're in though. So
that's a great way to sum it up.
Yeah, I like that. So thank you for coming on. And I will say that we have one more segment that I did not tell you about. It's called Hot Take. Are you ready for hot take? So I'm gonna give you two things, and you just gotta pick one.
Okay.
All right. So he's down for hot take. All right, you ready to go? Hot take: ice cream or cake?
Ice cream.
Oh, okay. Ice cream person. I like that. I like that. Do you like ice cream cake?
I liked it as a kid. I got a bunch of Baskin-Robbins ice cream cakes when I was a kid.
Those slap. I love those. All right. Would you rather watch a movie or series?
Go with a movie.
Okay. Okay.
I'm a lot more likely to put away my phone and stop doom scrolling if I'm actually sitting down for a movie, but somehow I can't help myself when I'm watching a TV show.
Yeah, I feel that. Would you rather be too hot or too cold?
Rather be too cold.
Okay.
Because I can bundle up.
Yeah, exactly.
And maybe this gets back to why I like Seattle more than Virginia.
Yeah, I know. All right, this is an important one. Candy corn or gummy bears?
There's only bears.
Answer on this one.
It's got to be gummy bears.
There's only one right answer on that one. No, I'm joking. There's no right. All right, last one. Drum roll, and it is West Coast or East Coast?
West Coast, hands down. West Coast, best coast.
Let's go. Throwing up the W's. All right, thank you. You passed hot take. Good job, man. First time on the Inside ABODE podcast, and you passed hot take with flying colors. So I appreciate you. If you have 30 seconds, give people how they get in touch with you, your spiel, whatever.
All right. Follow Windermere Economics. So that's the brand. That's the brand. And check us out on YouTube. Check us out on Facebook and Instagram. Putting out videos and putting out posts with some charts. I'm going to post one about mortgage rates in just a few minutes when we wrap up with this. So follow along there for all of my latest hot takes.
All right. Well, that was Jeff Tucker, ladies and gentlemen, Windermere real estate principal economist. Recently just joined us. I'm really fortunate that you came on. Thank you for coming on today. This is really a big deal for us to be able to listen to you talk about the market. You're very knowledgeable, obviously, and hopefully people got something from this. And yeah, I'll have to have you on again at some point in time. We'll go live again. This was fun. Thank you.
Yeah, I had a blast. Thanks for having me on, Dave.
Yeah. All right. And with that, ladies and gentlemen, you know what to do. Subscribe, and we'll hit you on the next one. All right. Peace.